Bitcoin was trading somewhere between $50 and maybe $65 to $70,000. And then with President Trump winning the election, Bitcoin has jumped from that range up to nearly $100,000. So if you missed out on the big jump in Bitcoin, here are 7 different strategies for owning and investing in Bitcoin without actually owning Bitcoin. What's up, you guys? Welcome back to the Average Joe Investor channel. Now, I'm not here to tell you to invest in Bitcoin or to avoid it completely like the plague. But what I can tell you is there are other alternative strategies that you can use to indirectly invest in Bitcoin or utilize Bitcoin to create cash flow. And I'm all about creating cash flow. Number 1 on the list here is purchasing Bitcoin ETFs. You don't have to own Bitcoin to own Bitcoin. You can actually invest in a number of different ETFs, and here's a list of them ranked based on their market capitalization. The number 1 here by far is IBIT from iShares, the iShares Bitcoin Trust ETF. You've also got GBTC from Grayscale, FBTC from Fidelity, ARKB from ARK, BITB from Bitwise, another one from Grayscale, BTC, BITO from ProShares, and of course the list would not be complete without a leveraged ETF here for Bitcoin, the BITX 2X Bitcoin Strategy ETF. All of these ETFs give you exposure directly to the price movement of Bitcoin, up or down, and for all these ETFs, you don't need to own a crypto account to invest in them. Second strategy here is to invest directly into companies that are part of the cryptocurrency or Bitcoin services. First thing that comes to mind here is owning companies that are Bitcoin miners, and here's a list of companies based on their market capitalization that are in the Bitcoin mining industry. Now, the number 1 here by far is Marathon Digital Holdings. Ticker symbol is MARA or MARA. Number 2 here, you've got Core Scientific, CORZ. Number 3, Riot Blockchain, RIOT. And there are others listed down below. You can also invest in companies that are directly part of the Bitcoin economy, such as Coinbase, MicroStrategy, Visa, Beyond, Riot Platforms, and PayPal. Strategy number 3 here is to invest in companies that are heavily investing in Bitcoin. This has actually been very interesting to follow here in the news of late. The big one here is MicroStrategy, ticker symbol MSTR. They've been buying an insane amount of Bitcoin. It makes up a significant part of their assets, and it's a huge bet by the company. Essentially, by investing in MSTR, MicroStrategy, you're investing in Bitcoin almost directly. This is evidenced here by the list of Bitcoin holdings by public companies here. Number 1 by far, MicroStrategy owns 252,000 Bitcoin, valued around $9.9 billion based on their cost basis, now worth approximately $23 billion, and makes up over 1% of all Bitcoin in supply. You could also invest in Marathon Digital Holdings, which we already talked about, MARA. Galaxy Digital Holdings, which owns 15,000. We've got Tesla, which owns 11,000. Coinbase Global, or Coin, owns 9,000. Hut 8 Mining, Riot Platforms, Block, etc. Now this makes for an interesting strategy here because it's essentially a twofold approach. You're getting indirect exposure to Bitcoin because these companies have a significant ownership in it, but the more these companies have other types of businesses and services that gives them diversification, the more of a less risky bet that is for you, the average Joe investor. Now these first 3 strategies were more of the buy and hold type of strategy where you're making a bet on Bitcoin in general, say I think Bitcoin's going up from here, so I'm going to own Bitcoin ETFs, I'm going to own companies that own Bitcoin, etc. But really want to transition here to alternative types of strategies that involve Bitcoin, but are also focused on exponential growth as well as creating cash flow. Strategy number 4 on this list is to utilize a Bitcoin ETF or any other type of direct or indirect Bitcoin stock to create cash flow by utilizing the wheel strategy. So what do I mean by the wheel strategy? I mean selecting a stock or an ETF and selling options on that ETF. And when we talk about the wheel strategy, that means both selling covered calls when you own the investment and selling cash secured puts when you're holding cash. As you can see here on the graph, you start in cash, you sell cash secured puts. And how aggressive you are with those cash secured puts is going to depend on what you're trying to accomplish. You can be aggressive and create a lot of cash flow, be more conservative and get less cash flow. Then eventually you get assigned, you own shares of the stock or ETF, you start to sell covered calls. You sell covered calls and you can be super aggressive or more balanced in your approach if you want more capital appreciation versus cash flow. And eventually along the way you get assigned again, you're back in cash, and the wheel continues through that cycle. As a quick example here, we'll look at the ProShares Bitcoin ETF, BITO, which is my favorite here because it is the only one of the Bitcoin ETFs that actually offers weekly options and has more volume and liquidity. For example, let's say you were in cash and you wanted to start by selling cash secured puts. We could start with this 2-day option here if we wanted to, or we could go to the 9-day option. Say we wanted to sell cash secured puts here, price is $24.40. And if we looked at the $22.50 strike price, we could collect somewhere between $35 and $85 here, which is quite the wide bid and ask spread. Could be because this is after hours, but let's say you could collect $50 here. That's a pretty sweet return. And eventually you could keep selling those cash secured puts till you get assigned. Then you swap over to selling covered calls over here. Quite a bit of premium to be generated. You could also work with Mara, which is Marathon Digital Holdings here, which is again a Bitcoin mining operation. And you can see here that's priced about the same as BITO. And you can do the same thing. You can start with cash secured puts here and sell cash secured puts on, like, see right here, the $23.50 strike price. The market's was down 5.5% with Mara. You could sell the $23.50 strike price here for $48, which is really good premium for 2 days. And then of course, once you get assigned, you could sell covered calls. If you were to potentially collect, let's say $30 per contract on a weekly basis, I'm just making an assumption here that you could collect 30. It probably would vary from week to week, but 30 times 52 weeks is $1,560. And your exposure, the amount of capital you had invested was $24.97, so divided by $24.97 here, would be approximately a 62% yield on your cost. So strategy number 4 was really about creating cash flow through the wheel strategy with Bitcoin-related ETFs. Strategy number 5 utilizes options, but its goal is not to create cash flow. Strategy number 5 involves buying LEAPS options for long-term exponential growth. So what do I mean by purchasing LEAPS options? A LEAPS option is essentially an option contract that doesn't expire for a very long time, usually at least 6 months here. But I think of a LEAPS contract as much further out. If we look here, we can see right around January of 2027 or January of 2026, September of 2026. These are the types of LEAPS contracts here. And these LEAPS contracts are really special because as an option buyer, we usually are all about selling options, but when we're an option buyer, we really have to be concerned about theta decay. And essentially theta reflects how much time decay occurs on a daily basis over time. And for example, if we look at this January 15th expiration, this contract is good for 779 days. And you notice the theta right here in this column here. If we're looking at, let's say, a 25 right here, it only loses 49 cents per day in contract value, which is a fraction of what you see for contracts dated 1 to 3 months in expiration. So you could go out there and buy 100 shares of Mara for $2,497. And if it goes up in value, then your shares will go up in value as well. Or alternatively, you could come in here and purchase a January 15th, 2027 LEAPS contract. And you could go at the money here at the 25 strike price and pay about $1,400. So about half of what you would need in order to purchase 100 shares. And what you'll find with LEAPS contracts is when the market goes up, your LEAPS contracts are going to appreciate in value more than your shares will. I just had this happen myself. Just as an example here, if you look at this SoFi LEAPS contract I purchased it about 22 days ago, and I purchased it for $396 right here. And since then, the value of SoFi, it was at about $11.50 when I bought this contract. It's gone from $11.50 to about $15.50 right here, which is about a 30 to 35% capital appreciation, but my contract has gone up 82% in value. So with LEAPS contracts, you get exponential gains compared to just holding the shares. Now, just as an FYI, when you're purchasing LEAPS contracts, you generally don't want to hold them all the way until expiration. I personally like the idea of holding them for at least a year and then rolling that contract or deciding to sell it for a profit. By holding it at least 1 year, if you're doing it in a taxable account, you get that preferential long-term capital gains tax treatment. Now, if you wanted to do it with BITO or the ProShares Bitcoin ETF, which is priced at $24.40 to be about $2,440 to buy 100 shares, or alternatively, you could purchase a LEAPS contract for BITO, which expires January 15th, 2027, and you could go right at the money at 25 and spend about, I don't know, $350, maybe $400 compared to $2,400. So you get quite a bit of leverage here. You get significant exponential gains above and beyond just owning shares of the ETF. All right, strategy number 6 here combines both the cash flow from strategy number 4 as well as the LEAPS contracts from strategy number 5. We're talking about a poor man's covered call strategy on Bitcoin related stocks or ETFs. Okay, so your first thought here is, what is a poor man's covered call? Based on a traditional covered call, but it's a little bit different. With a traditional covered call, you own shares of a stock or ETF, and then you sell call options against your shares to collect option premium, aka income. Now it's called a covered call because you already own the shares, so at some point in the future when you have to sell your shares due to assignment, they just take the shares you already own and it's covered, meaning you're not at risk of significant price changes in the underlying stock or ETF. They just take your existing shares. A poor man's covered call is a little bit different. Instead of owning 100 shares of the company or ETF, you instead have a synthetic long position by purchasing a LEAPS contract, which is either at the money or deep in the money, meaning far below the current market price, which gives it a very high delta, meaning that the price of the LEAPS contract very much coincides or changes with the actual underlying stock or ETF. Now with a poor man's covered call, you don't want to get assigned because then you potentially will be short 100 shares of the stock or ETF. And then otherwise it's the same as a traditional covered call where you sell call options and collect option premium here. So as a hypothetical example, if we're looking at BITO, you might purchase the January 15th, 2027 contract here, either at the money for like $400 or maybe deeper in the money here, let's say at the 22 or 21 strike price with maybe $450, $500. And then you would look at the more recent contracts like December 6th, 2024, which is about 9 days out, and sell a covered call essentially at a price above the current market price. So if it's at $24.50, you might sell like the 26 or the 26.50 contract, collect a little bit of income, which can be reinvested into this ETF, into more types of LEAPS contracts, into other investments, you name it. But you collect that income and you also participate in capital appreciation if the price of the underlying stock or ETF goes up in value, so will your LEAPS contract. Now with the poor man's covered call, you want to make sure you're never assigned on your short call or your covered call because as opposed to a traditional covered call, with the poor man's covered call, you're not going to have shares to be able to sell due to an assignment. So they'll still sell the shares, but you're going to be short 100 shares, which can be very dangerous, especially with a very high volatility stock like a Bitcoin ETF. However, with the poor man's covered call, you get extreme amounts of leverage. Your yield on cost goes up significantly because your amount of capital at risk is far lower. And the poor man's covered call in particular is great because you get the exponential gains of the LEAPS contract and you get a little bit of income, which I would argue you want to be very conservative with and go very far out of the money with a very low delta. So you can always go out there and just buy Bitcoin. There's nothing wrong with doing that, but you can also invest indirectly in Bitcoin. And I've evolved a little bit on this over time. I do believe that Bitcoin does deserve a place in your portfolio. However, I'm a firm advocate for making it a very small portion of your portfolio. Big believer in the stock market as a whole, specifically the S&P 500, because it has a long track record. Bitcoin doesn't have that track record. It has that potential store of value. It has potential uses in the future, but it doesn't have enough of a track record for me to say, yeah, make it a big part of your portfolio. A small portion, maybe 5, max 10% might make sense for you. Hopefully you found some value out of this video. Make sure to leave your 2 cents down in the comments below. It's my goal to respond to as many comments as possible on the day I post a new video. That's all I got for you guys. Have a great rest of your day, and thanks for watching.